Hi everyone, welcome back to Be Rich. Today, being recorded a little earlier. I don't know when Rupesh decides to plug this video in, but I hope you're doing well. If it is before Pongal, I hope your Pongal celebrations plans are going well. If it is post Pongal, I hope your Pongal was great. Either way, I'm happy that you're doing well. What I want to talk about is what happened during the pandemic crash and the progressive exuberance we have been feeling in India since then. Most of us who have entered the market, especially young viewers, have entered the market post pandemic, and that is when India saw a huge influx of retail investors. I think up to 35% new investors entered the market during the pandemic crash. And the sad thing is, most of us have entered this kind of a market without any knowledge or prior experience to investing, and this is where the problem lies. Because we do not have any knowledge on prior experience when it comes to investing and how the markets work, a lot of us got swayed, opened accounts, started putting some money in, and because the pandemic market was down, the market started going up, everything went down, and then everything started getting inflated. So wherever you threw your money, you saw some returns, some mediocre returns, or you saw some spectacular returns. And this has led to exuberance in the Indian market and in our group, where we are constantly in the belief that things are going to keep going up, 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 and there's nowhere but to go up. And this has been historically what leads to a big crash. Crashes are rare. Let me first say that. I am not here to say, oh, be scared, the market is going to crash. That is not what I'm saying. It can happen. Like a cyclone coming to Chennai can happen. We always see the cyclone coming towards Chennai and we see it going up, historically north, or going south to Pondicherry, Kadalur, and we're like, it never comes to Chennai. But those rare times when it does land in Chennai, it is very bad in Chennai. And all of us who live in Chennai know. We all seen those stories and those flood stories and how terrible it is for being in the city, especially without any foresight or forethought. They build apartment blocks in water catchment areas where historically there were lakes, in areas, as they say back then, there were marshlands. Those have all been converted into huge towering apartment blocks, and all those places get flooded. There could be a lot of questions asked, why was they given permission to do it? You shouldn't have done it. We need it. All that is true. This is the same truth that applies in the market. We are going through a spell right now where things are just been going from one step to another step higher and higher. If in case some, black swan event happens, like Nassim Taleb says, or, some terrible event happens and there's a small crack in the market, we'll suddenly see this flood situation happening in the stock market where a lot of people will lose money, and then we'll all be sitting there lecturing. And I don't want you to be the one suffering. Our markets are skewed extremely to one side, and they've been offering us supernatural returns in the short term and setting up some false expectations. It is also thanks to a lot of social media pushing by influencers and people sitting in social media like me talking about it, everyone talking about it. So that's why I want you to be cautious when you look at the market and see returns which you have already experienced. Your past returns does not guarantee you anything. As much as me saying, I took a blood test last year and my doctor said everything is great. That single blood test is not going to be enough to carry me through the rest of my life. If I said that, you'll call me a fool. That is the way you guys are participating in the market. You're looking at your returns. You bought ITC at 160 rupees. Now it's trading at 400 plus, sir. So that doesn't mean 400 plus is going to go to 800 plus within another 2-3 years. Maybe it can, but maybe more reasonable to think it'll go to 400. From 400 it'll go to 500, 600 and sit there for some time. I'm not saying it's going to go and crash and you're going to burn, but like I said, it can happen. So why am I saying this? The reason why I'm saying this, a lot of you are reaching out to me on Instagram and are asking me in the group especially, I've got some cash sitting on the table. I need to use this cash to either 2 years from now to send someone for education, or 2 years from now I plan to get married. 2 years from now I need to put a down payment for a house. So if I take this 20 lakhs, 30 lakhs, put it in the market, can I make a quick another 10, 15 lakhs on it? And the short answer is no. The long answer, I'm going to tell you why. Even if you have an expectation of making another 10, 15 lakhs on the 20, 30 lakhs, the reason is that the best, the Nifty has given an average around 12% return. So for 20 lakhs, you'll still be short by 4, 5 lakhs. That is the, mean average what the return is. That is good if it does it in 2 years' time. Even that I feel is unlikely. The worst case can be that 20 lakhs can suddenly go through, market can crack and correct, and that 20 lakhs may go down to 17 lakhs, which will be worse for you. because you were hoping to put that 20 lakhs which you could not afford to lose, and you're hoping to make an additional 10 lakhs on that and pull it out on the market in 2 years' time to make an important investment or a payment for something in future spend which is there, which is written already in stone, which is happening. Stock market is not a place where you can take this kind of risks. Stock market does not owe you anything. It is extremely risky, and that is why we look at it in long term. The advantage when you look at stock market in the long term is it mitigates most of this risk. What do I mean by mitigate? Mitigate means it lowers these risks or the effects of these risks. That means spreading your bets over long stretches. So this is the idea which I wanted to share with you as far as investing in the stock market for the short term is concerned. So if you have money for the short term, what should you do? That is the next question, which is a good question. Currently, if you have some cash sitting on it, there's only two options for you to see. If you don't need to pull the money out in short term, meaning little less than 2 years is what you need to pull the money out in, then I would say stick it in gold. Gold is safe right now, and gold price, the way it's looking, where the Chinese economy is at, the deflation in their economy, and what's happening even in their long-term yield, government bond yields, they also seem to be consuming a lot of gold. They're still not overtaken India. They bought around 5 tons of gold, and we have bought around 8 tons is what I see. So if you're looking at putting it in the short term, like in a year or so, gold is a great place to be in. If you don't need to pull it out in a year and you have some more time to play with, then I would suggest you put it in the bond market. You get the interest on the bond that you can accumulate and towards your future expense or investment which you want to make, or you can take the interest and invest the interest in the market right now, buy shares directly in the market. That is the strategy I would advise if you have some cash which you want to invest right now, which you don't need for a couple of years. I would not advise you to go put everything in the stock market and then lose it. So if you are looking at the stock market, like I've said in the previous videos and I've spoken about it in great length, please look at it in the long term. If you're looking at it in the long term, you're much better off. And if you're one of those fortunate few who entered the stock market during the pandemic time, what this pandemic boom has given you is the stock market boom. It has given you a head start. It's given you like a booster launch. It's pushed you out into space. From here, you have to go on your own energy and move forward. You don't have to fight the gravitational force of Earth, but you do have to avoid getting sucked into a black hole, as I say. So take that as as a boost. You are lucky, you're fortunate, you saw an opportunity, maybe planned or unplanned, and you invested in the stock market and you've got a boost. Now continue doing that. Continue investing, looking at it in the long term, and don't look at it in the short term saying, I made some returns, so much X returns in the last 3-4 years, and I can definitely pump some money in which I need 2-3 years from now and make those kind of returns. You won't. That was the main point of this video which I wanted to get it across to you. So I hope you do enjoy this video. I hope you do enjoy your Pongal, even it's before or after, like I said, and be smart when you're investing. And like I said, there are opportunities to invest lump sum monies, and I've given you those strategies too. If you have any more questions, catch me on the Instagram group. We'll have a discussion there too, like we've been having all this time. Nothing else more to say. Stay invested as always. See you in another video soon. Bye. Thank you for watching.
Hey guys, that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it, and we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.